All right. Well, first of all, I want to thank everybody for coming this afternoon. I'm sure, if you're like anyone else in this country right now, you're extremely busy. We do appreciate the time that you are spending with us this afternoon. For those who are wondering how long this might take, I have some good news. I don't expect to take the full hour. If any of you are disappointed by that, please feel free to call me and I can talk to you about retained earnings or something of that nature for as long as your heart might want. But for the rest of us, we're looking at somewhere north of 30 minutes, somewhere short of 45 minutes, and not including any question and answer time that we might have along the way. So thank you again for showing up, and assuming everybody is ready, we're going to go ahead and get this presentation started. So again, the topic for this presentation is succession planning and M&A strategies within the staffing market. And that is a lot of ground to cover. Frankly, we could talk about just succession planning or M&A and spend more than the full time allotted, and we could delve into many topics in each of those. So because of the broad nature of the topic, this will be necessarily broad as well. But with that said, we do think there is some useful information here, and we hope that you find it enlightening, and happy to answer any questions both during this presentation as well as offline if there's something we didn't address or if you need more depth. So with that started, my name is Jacob Katz. I am a director in the valuations group at UHY. UHY is a national firm, accounting firm, but we also have a national advisory firm. And our valuation group deals with companies all over the country and frankly all over the world, including a very large practice in the staffing and PEO market. So we will be sharing some of the insights that we see in that market and hope that you find it useful. So let's talk about what the overview is and specifically what the goals are for today. First of all, we're going to spend a little bit of time talking about the state of the industry as well as the economy. We're going to talk about the difference between succession planning and M&A, not so much on a definitional standpoint, but how you look at things differently depending on if you're going the succession route or the M&A route. We're going to talk about the keys to each of those areas, and then we'll also wrap up and talk a little bit about things not to do. It's a relatively broad agenda, but we will delve very deeply into some of these and hope you find it enlightening. So let's start out with the economy. The economy is something we are all, to some extent, beholden to, and we won't spend a great deal of time here since I'm sure that many of you are aware of the state of the economy. But here's the total GDP over the last 5 years. And you can see it looks like we went on a very dangerous trip through the Antarctic and got stuck in a crevasse that is the pandemic. This is over the last 5 years, but if we were to zero in a little bit more closely, this is since the end of 2019. Now, you can see here that this COVID crevasse was substantial from a GDP standpoint, but so was the recovery. And although we haven't quite returned completely to long-term growth, as we saw previously, much of the growth has returned, and we've made back what we lost on a GDP standpoint. On the employment side, we could spend a great deal of time talking about unemployment, but certainly I think that the unemployment rate has a little bit too much noise in it. So here we're focusing on total employees. And on the total employees side of things, we see that things have not returned back to where they were on a pre-COVID basis. And the employment gap is, in fact, substantial. We are still looking at likely at least another 12 months, if not substantially longer, to return to long-term norms, partially due to the state of the economy, but also due, at least in part, to the lack of some members of the employment group not seeking employment. Now, interestingly, if we look at this particular area, this is what we see as the PPP effect. And I'm going to put my headphones in because I do seem to be getting some feedback. Of course, we tested this and it was fine, but now that it's live, we're getting feedback. So I'm going to put my headphones in just to see if that helps improve things. So this PPP effect certainly returned a number of jobs relatively quickly and actually increased the nature of the return of jobs, but then it waned substantially, especially as that the last of the first PP started to expand. Apologize, of course I'm getting a call and it won't decline, so there we go. Now let's look at average hourly wages. When we look at average hourly wages over the last 15 years, we see that things have continue on the long-term trend, although we did see a decline after the mortgage crisis 2008. Of course, on this graph, we see what appears to be a relatively small spike, but when we focus in on that, it looks much larger. Now this, for those of you who aren't familiar with the average hourly wage statistic, this can be counterintuitive because we saw a substantial increase in our hourly average wages during the COVID crisis. And that is because a number of the hourly wage earners on the lower end of the scale were terminated, whereas many of the high earners, many white collar jobs, and certainly salary earners kept their positions, and therefore, on average, the wages actually went up over the total economy. We obviously still have some noise in the system, but the good news here is that the long-term trend line is returning back to normal as well. Now, if we look at the Great Resignation, and that is a term that the media has, their vast marketing departments have come up with a great term. The Great Resignation is the fact that many of the employees prior to the pandemic are not returning to jobs they previously held. Now, the job of any good media group is to find headlines that will cause you to watch or click on a headline. Most of the time, those are, what are you eating for dinner that may kill you in the morning? Or if you drive this car, you may want to actually watch this news report. In this particular case, the Great Resignation was so substantial that the primary headline that we found was why the Great Resignation in 2021 is a sign of hope. In other words, they had to fake everybody out by having a positive headline in order to get people to actually read it. Now, with that said, there were plenty of headlines on the opposite side as well. And there is no doubt, and I'm sure everybody in attendance would agree, that it is difficult in this market to find employees. This actually creates a bit of a window for staffing companies whose expertise is finding employees whether or not it's difficult. That is your expertise and does create a bit of a window for you to implement on behalf of customers and clients. Now, if we turn our attention directly to the staffing industry, when we look at year-over-year growth, we see IT staffing as of this data is approximately a month old, 23% year-over-year growth in IT staffing. And within the industrial staffing, we're looking at 29%. Within the office staffing, 47%. And the real hair in this race has come to a surprise to no one, is in the healthcare, specifically traveling nurse staffing, which is in excess of 100% year-over-year growth. So we're looking at revenue growth that is substantial in your marketplace. And although these growth rates do represent part of that V recovery, they aren't likely to slow down too much in the near future. But over the long term, we do expect to see them return back to normal, much like we've seen across the economy. In fact, when we look at projections of your industry and the staffing industry projections over the next several years, what we are seeing is approximately 1.67% compound annual growth rate. What does this mean for the industry? Well, we've had a window where all companies had to deal with a great deal of disturbance. But the longer term trends create an opportunity for staffing industries because it
speaks directly to their expertise. But at the same time, the longer term growth rate, although not negative, isn't substantially positive. And whenever you see this confluence of events, we tend to see an increase in M&A activity. And the reason is because when you can't necessarily hit the growth rate you're looking for organically, companies are out there looking to do it inorganically. So whether that is one company buying other companies within its industry or PE money moving into the industry in order to roll up. This is the type of environment where we would expect to see greater M&A activity. So let's talk a little bit now that we've talked about the state of the economy and the industry. Let's talk about succession planning before we move on to M&A. Specifically, let's talk about how we would value it. Now, before I get into valuing a staffing company, to make sure we're all on the same page, I want to talk about cash flow so that we all understand where we're coming from. So a very simple income statement starts with revenue. And then from revenue, we subtract cost of goods. In your industry, that's primarily labor, and that gets us to gross margin. Once we have gross margin, we subtract out our operating expenses. And then what we end up doing, for those who aren't as familiar with EBITDA, is we take the operating income and we add back depreciation, amortization, and interest to arrive at EBITDA, which is a measure of cash flow. EBITDA standing for earnings before interest, taxes, depreciation, and amortization. So let's just take a moment to make sure, again, we're all on the same page. Why do we look at EBITDA and not net income or not revenue? Although we can certainly look at revenue, we can look at gross margin as well, especially in the staffing industry. The reason that financial people always track down to EBITDA is because this is the best jumping off point for determining what is the actual cash flow of your company, independent of decisions you might make. So first of all, depreciation and amortization is a non-cash expense. So we add that back because nobody sits there and writes a check for depreciation. It's non-cash. But we also take out taxes. We add back taxes. And that's because, although I probably shouldn't say this on a recorded webinar, taxes are to some extent voluntary. Not that you can ever get away with not paying taxes, but that you can choose to pay more now and less later, or less now and more later. And so that becomes an inflection point because it's up to the decision of the owner of the company. And the same is true with interest. You could choose to use more debt or less debt than, say, I might choose. And it becomes another decision point upon which we want to eliminate what you would choose versus what a hypothetical person would choose or hypothetical group would choose. So we add back interest. And that's why we use EBITDA. And anytime you've been at a cocktail party and somebody says, my company, I was able to sell it for 4 times, they are meaning 4 times EBITDA. Almost assuredly, whatever their EBITDA was, they sold it for 4 times that amount. So now that that definition is in place, let's look at some of the transactions history. So here we have the quarterly transactions going back to 2017. And as we can see here, in 2018 was the high point, 71 transactions that quarter. And the low point, no surprise, during COVID, 13 transactions. So what we see here is yet another, just like we saw in the economic data, another V recovery. And as you would expect to see, given all the data that we reviewed previously. When we look at public companies and we determine what are they trading at as a multiple of EBITDA, splitting it up into different segments of the staffing industry, what we see is that the average public company is trading at about 7%, their 7% EBITDA margin. They're getting 14.1 times EBITDA. That's a high number, and that's something that has to be adjusted when you're looking at a non-public company. So it has to be adjusted for a few things. First of all, the stock market has been doing well for an extended period of time. I'm not going to say that people are being irrationally exuberant. They might be being rationally exuberant, but we have to adjust for the momentum that is in the market. We also have to adjust for the size of the company relative to any company that we're looking at. So when we take those adjustments as well as others in mind, and we adjust for a middle market to lower middle market staffing company, the current public company EBITDA multiples are coming in at about 9. Now, if we look pre-COVID, they were at about 6.7. And we do expect the multiples to come back down towards those mid to low 6s on an adjusted basis. When we look at private companies in staffing, with private companies, we don't always have an extended amount of data. It is, with private companies, we have to rely on those companies that are willing to share their data. And so took a look at the last 24 months, and frankly, there aren't a lot that are willing to share the data, but here's what we're looking at. So revenues along the bottom, EBITDA multiples along the vertical axis. And here we're seeing trading multiples between 2 and 6. Again, I think the 6 is probably at this point slightly low because we're looking at a small sample size. There was another transaction that was 18.1 times, but that one clearly had some synergies and some interesting aspects to it, so it was excluded from this survey. So what that means to us is that in the private company staffing industry, you're looking at somewhere between mid to upper 5s to mid 6 times EBITDA multiples. And there are certainly exceptions to this. So a pure healthcare staffing company that is being run well and doesn't have any additional accoutrements such as payroll or search might actually trade higher than that. And then there are other ones that will trade lower depending on the circumstances involved. So I can talk to you about the broad nature of it, but let's talk specifically about what you should be doing in the succession area. The first thing is we have to define what succession planning truly is. The first thing I would tell you to consider is, are you looking, to the extent that you are looking at succession planning, are you looking to hand off your company to somebody in your family? Or are you looking to hand it off to somebody in your company? Or are you looking to hand it off potentially to both? Now, if you're looking to sell it to a third party, then that is something entirely different. That falls into the M&A. But you have to define that, because when you choose to hand it off to family and how you go about doing that may be an entirely different strategy than handing it off to somebody that already works in your company and is looking to buy in, or rather even buy you out, or a group of people. Regardless of who your target is, the first place you really need to start is with the valuation. This doesn't have to be an extensive drill down into exactly how much the company is worth for any given purpose, but rather an understanding more broad than some guy on a strange webinar saying that my company should trade at 6 to 6.5 times EBITDA. You need to take a look at what is the specifics of your company, your cash flow, what your market looks like, what your advantages are, what your risks are, what your opportunities are, in order to determine what is the best strategy for moving forward. Now, once you do that, and in the process of doing that, you're going to want to engage your entire team. Of course, you need attorneys. They're the ones that write agreements. They're the ones that review the existing agreements. One of the first steps that we have to take in succession planning is determining, is there any ruling document in place that is going to define exactly how, when, and at what price a company transfers? And to the extent that does not exist, we have a little bit more open territory. To the extent that it does, we may need to either revise or consider how to use those documents. Certainly your accountants are going to be involved because there's a great deal of financial data. And I would also tell you that we see a great amount of success with companies that the management team or the owner or both are dealing with mentors in their industry to understand, hey, what's going well, what's not, what have you heard in the transaction space. You can even go to your industry association, such as SIA, and determine what does the market look like today. And then again, it's once you have done all this, let's understand who you're handing it off to. Now, I will tell you, there is one other thing that specifically in the succession planning, we would suggest that you all consider. And that is, you should be starting today. And the reason that we say that is I will tell you that the number of companies in and outside of the staffing industry that are changing hands within family or within management companies is skyrocketing, and it's skyrocketing for a particular reason. Right now, the tax uncertainty over the next 12 months at the most is extremely high, about as high as I've ever seen it. And this is just one example. Now, in this particular case, the company was worth $68 million, and we were looking at it on the estate side. What would happen if this owner died while still owning the company? And today, it's not great. We'd lose $22.5 million roughly in estate taxes. If some of the proposals, just some of the proposals that are being talked about in Washington right now are passed, that $22.5 million is over $40 million, or we're talking about effective rates that go from the 30s all the way up to nearly 60%. When you combine that with the fact that today, to the extent that you haven't used it, you can have up to 11.7 million in credits against gift tax. And if you're married, you can have twice that much. So you have up to $23 million. That's a very, very lucrative environment. And we expect that environment to go away sometime in the future. I would expect there to be movement on this long before midterm elections. I don't expect the Biden administration to be as cavalier about the thin majority that they currently have going into next year. In other words, in the face of midterm elections, we do expect there to be some movement, even if the Biden administration itself would be otherwise wanting to be more compromising. We do think the left side of the party is likely to push in 2022 in advance of midterm elections. If we go into midterm elections and the Democratic Party picks up more, we expect there to be even more pressure. Now, I will tell you, when it comes to predicting the future, I don't have a crystal ball. Nobody has a crystal ball, but I do know what exists today. And again, these type of figures are things that we haven't seen in the history of the country before, and now is the time to take advantage of. So returning back, let's talk about the things that you need to think about in succession planning. First of all, it's financial records. If you started your company, or perhaps you inherited your company, and you've been running the books the way you've been running the books, that can be fine. But in order to proceed with valuation, gifting, or selling, you need to have very clean financial records so that the cost of assessing value and the cost of transferring that value aren't in excess of what they should otherwise be. So that means if you're thinking about succession planning, now's the time to engage your accountant in order to make sure that your books are being recorded correctly, and not just correctly, but in a way that could lead to the transfer of assets in the future. You also want to understand your strategic direction. Is your current management team the one that you're going to empower to take this company forward? Is now a good time for you to decide to get out, or do you want to stick it out longer? It's not just the strategic direction of your company, but yours as well. And then in doing so, when we look at valuing a company in the staffing industry, we almost always start with, and oftentimes we will end with, an income approach. And here, there's a couple approaches to consider. There's what's called a capitalization of earnings, which is a look backward, and I'm sure everybody's encountered the discounted cash flow, which is a look forward. If anybody's ever acquired a company or been acquired, you are likely used to dealing with the latter, the discounted cash flow. And that's very important because it gives you a picture of what the next 5-10 years of the company might look like. And then you discount that income down to today to determine what the value is today. And it's a very valid, very commonly used way to value a company. With that said, if in answering the earlier questions, you decided you're going to be giving this to your family, or you're going to be selling it to somebody in your management company, the discounting the future operations, which they have not actually done yet, and selling those future operations to them maybe makes a little bit less sense than saying, okay, what has the company done recently, and how likely is that to repeat in the future? So in most cases of succession planning, we would suggest capitalization of earnings makes the most sense. It also makes the most sense if you're ever in a situation that might be litigious, because to the extent that your discounted cash flow becomes more rosy, then the value of the company goes up. To the extent that your discounted cash flow becomes more pessimistic, then the value of the company suddenly goes down. So unless you are in a position where you are regularly doing forecasts, and not over the next 12 months, but over the next, say, 5 years, in succession planning, discounted cash flow is less likely than capitalization of earnings, with the exception of one area, which we will talk about in a little bit. Now, we also often use the market approach. What are other companies like yours trading for? Now, here, one of the biggest mistakes we see is in comparing yourself to public companies. We've seen people and firms not size adjust. If your company is making 15 million, 25 million, and you're comparing yourself against a company that makes 800 million or $1 billion, you need to adjust those cash flows to take into account the economies of size. Oftentimes, we see that get missed. Precedent transactions, companies that, like yours, that have transacted in the past, the key thing is make sure they're comparable. So if you are in the healthcare space, we would suggest comparing yourself against healthcare transactions, not against, for instance, industrial transactions. Unless there is evidence presented that the segment matches your segment relatively clearly, those transactions are likely not nearly as comparable as you might otherwise like. And again, this goes back also to the income approach. Begin with the end in mind. Let me be really clear about something. Any valuation my firm or I have ever done, we do it the right way. In other words, we don't manipulate the numbers to make it higher or lower. But we have a lot of tools in our toolbox, and within any given scenario, we could be $1 long or $1 short. So if we know we were doing it for estate planning reasons, we might decide to be $1 short. Whereas if we know we're going to be, for instance, selling to a third party, we might be $1 long. So begin with that end in mind. And then finally, be defensible. You know, I really do like being able to go to sleep at night. So knowing that someday I might have to talk to the IRS, or I might have to talk to attorneys, and I'm not sure which of those would be worse, and I've had to talk to both of them. I want to know that the work I've done is defensible, and you want to make sure that anybody in your team who is helping you with this is doing so in a defensible way. So let's talk then about gifting within family. Typically, you want to minimize the value. That means that we're not going to necessarily look for as many add-backs as we normally would. Whereas if you're selling to family or employee, well, you probably want to transfer it at fair market value. In other words, a very fair price, not too high, not too low. If you sell it even to employees for too much money, that invites litigious action in the future. If you do that to family, that makes Thanksgiving unpleasant, but it also saddles them with an additional amount of potential debt or seller note that they might not otherwise have to deal with. Now, when you're selling to a third party, you want to maximize your add-backs, or which translates to maximizing the value. So let's talk about another strategy in succession planning that is very commonly talked about, and that is discounts. There are two primary discounts that you will see in succession planning you are less likely to see in the M&A market. The first is lack of control, and the best example I can think of is which one is worth more, a plane that you share or a plane that you own? And sharing planes, very common right now because it's less expensive. Now, if you own the plane, if you own the entire plane, you get to fly it where you want, when you want, how you want. If you're sharing it, you don't. And because of that, a shared plane that you don't fully control is worth less, and that's why it's less expensive for you to contract. We do the same thing with gifting in succession planning. When you are gifting or selling less than 50% of the company, you can expect that there will be discounts from that lack of control. And they range anywhere from typically 5 on the low end to 20 on the very high end. And most of them are going to be centered around the 10 to 15%. So whatever the value of the equity is prior to that, you would shave off, let's say 5 to 20%. The second common discount is discount for lack of marketability. Well, let's say you own a $40,000 Chevy Camaro or $40,000 of GM stock. If you wanted to sell that Camaro, you have to determine what a fair price is. You have to then advertise it, and you have to wait until somebody decides they want to buy it. And if you know that there's something wrong with the engine, you may have to disclose that as well. Whereas $40,000 of GM stock could be sold 1 minute from now for $40,000 if that's its current value. And so because of that, if you're in a private company that is not trading on the public markets, you get a discount for lack of marketability. And those vary dramatically, but typically they're anywhere from 15 to 25%, with some being higher and lower. Now these don't get added together, so you take the discount for lack of control, here's your new equity value, then your discount for lack of marketability, and your final equity value. And then the second strategy we see very commonly, I'm guessing that many of you have done this, and that is share classing. So you take the share units of a company and you split them into A and B shares. In this case, let's say there's 10,000 shares, and so you split them into 100 Class A voting shares and 9,900 Class B non-voting shares. Then you transfer those Class B out, but the original owner, who still owns the 100 shares of voting, controls the company. They control the company even though they only have a small portion of the value. So let's take a look at what this might look like. Let's assume a staffing company is worth $10,000. Option one is they have 10,000 shares, so it's $1,000 per share, and we don't want to lose control, so we're going to transfer 49%. That's worth $4.9 million. We take our discounts for lack of control and lack of marketability. We get us down to $3.5 million, or roughly $720 per share. Option two, we create Class A and Class B shares. Shares outstanding, 100 Class A, 9,900 Class B, still 10,000 shares. 100 shares out of 10 million is worth 100,000, 9.9 million on the Class B. The value of non-control then, all 9,900 shares are non-controlling. So therefore, we can transfer 9.9 million of this $10 million company without losing control. We take our discounts for lack of control and lack of marketability. These are the same percentages we saw before, but against much larger numbers. And now we've transferred $7.1 million at the same effective price per share of $720, but we've transferred more of the company without losing control. And that is how many owners have their cake and eat it too. They can transfer it, whether it is to management temporarily or to family. They can transfer it while maintaining control with the original owner or owner group. There are some limitations to this, of course, but it is something we see very commonly. And then finally, said I'd talk about this earlier, should you consider an ESOP? Now, I'll be honest, many times we see ESOPs in the staffing and out staffing industry, and it's usually a second bite at the apple. In other words, if somebody doesn't want to keep it in the family, but their management team doesn't have the money to purchase it, and they haven't been able to sell it to a third party at a price that they like, then ESOP becomes a very viable alternative. And there are some substantial benefits of an employee stock ownership plan. First of all, the owners get the full value of the company. There's potential tax deferral, which we're not going to get into the details of that, but they are substantial. And then you also get to reward management because now they are the purchaser. And to the extent that the selling price becomes partly financed by the ownership group, you actually can get potential income stream. Let me pause for a moment and just say, in just a few moments, we're going to be taking a poll, and then during that poll, I do have a couple questions that I will be going over shortly. All right, drawbacks. What are the drawbacks of that? You do need a qualified management team. So you need somebody or a group of somebodies that you can trust. You need experienced ESOP advice. The reason that you need experienced ESOP advice is because this is a niche environment. So you're not just valuing a company and selling it, but you have to also understand what the Department of Labor is looking for when you're doing this, because the Department of Labor does regulate it, which is why the biggest potential drawback is that liability. The valuation on an ESOP is critically important. And then finally, you have ongoing maintenance costs, where the value of the company has to be measured each year, and that can be costly as far as time. It's not super expensive after the first year, but it can be a substantial expenditure of time. So let me pause here and give me a moment to launch a poll. And after I launch this, I'll leave it up for a minute, and I'm going to go over some questions as well. Okay, so you should see, with regards to your company, have you considered selling, gifting, transferring, or none of the above? And while you're answering that, let me go over a couple questions here. Are the sales times EBITDA based on 2020 numbers or an average of EBITDA over, say, 5 years? Excellent question. So when you are valuing a company, typically you are looking at the trailing 12 months. When you're talking about just pure EBITDA multiples, you're looking at the last 12 months. However, when you're doing a full valuation, that may not necessarily be true. For instance, in a capitalization of earnings where you look back, you actually, closing the poll, you actually can look back at 2 or 3 or maybe 5 years, although typically you give more credence to recency. Now, with that said, 2020 is typically being underweighted right now. We don't necessarily, even if we're looking backward, put a great deal of weight on 2020 because it is such a special year. I can tell you that after the mortgage crisis of 2008, we did not spend a lot of time focusing on data from 2008 as early 2010. And I can tell you that in 2022, most people are going to ignore data coming from 2020 in all likelihood. And then keep in mind when you're looking forward that at discounted cash flow, you're looking at the next 5 years and discounting each year back, or the next 10 years and discounting each year back. And then somebody asked, is the seminar focused on staffing companies? It was not clear in the invitation. I apologize for that. We are presenting this as a staffing company. Now, with that said, almost all of this material, with the exception of what's happening in the staffing market, is germane to any company or any form of business for that matter. So these conversations are very commonly had in manufacturing, in healthcare, in professional services, outside of staffing, but this is focused on the staffing industry. Okay, now let's see if I can find what this poll said. So 47% of respondents said that they've considered selling the company to a third party. 27% said none of the above. 20% have considered gifting all or a portion of the company to a family, and 7% have considered transferring to existing management. So it looks like not quite the majority, but the plurality of attendees are looking at selling a company to a third party. So with that said, let's talk about that. Here I'm going to focus more on the things that are different. So a lot of the valuation is the same, but not entirely. But let's focus on some of the things. What I said earlier about financial information as it relates to succession planning is doubly true for selling a company. So I will tell you that if you have audited or reviewed accrual-based financials, your process of getting to a sale is much smoother, much easier, and much less expensive. Now, if you don't have audited or even reviewed financial statements right now, that's okay. We can still get there. It's just you need to do some prepping on your financial data, because anybody who's going to advise you, whether it's a broker, whether it's a sell-side advisor, whether it's an attorney, whether it's an investment banker, he or she is going to know what the buyers are looking for, and you need to present the data in that form. To the extent that you are doing cash-based accounting, it makes it more difficult. We do it all the time, but it does make it more difficult. Some buyers will actually require a quality of earnings analysis. The good news about this is that if a buyer does require it, the buyer gets to pay for it. The bad news is it is only slightly more enjoyable for you than an audit. I mean, I'm joking, it's a lot more enjoyable for you than an audit, but then again, that's a pretty low bar. They do take a very close look at things, and they don't just look at your expenses and track things. They look at how your revenue is coming in, to the extent that it is something that they can duplicate if the company is purchased. The other thing that we would tell you is people will get calls out of the blue all the time from people looking to buy their company, and they will get a letter of intent. As a seller, do not sign it unless you are willing to sell. The number one reason for companies not transacting after an LOI is because the seller changes his or her mind. And I will tell you that going from LOI to the decision not to close or the decision to close is an expensive choice. You should only decide to go past the LOI if you think that if they come to the table with this deal substantially intact, I'm willing to close. Otherwise, you are spending money and time and being somewhat distracted by something that didn't need to occur. I do a number of transactions every year, as does UHY as a whole. We do many of them, and let me tell you, one good thing about it is we get to be your bad guys. So if you don't like something that the potential buyer is saying, we're the ones, or the attorneys are the ones, or your brokers are the ones that get to tell them that they're full of it. And so let them do that, because you may be talking to somebody that you'll run into in the future, and you can then always say, you know, that Jacob Katz, man, I thought he was a nice guy, but man, he was a jerk. And I've been called on more than one transaction Dr. Death because of it, and that's okay. Our job is to protect your interests and get you to where you want to be, and sometimes it's easier for us to be the bad guy. And then understand your Addbacks. So we're going to talk about Addbacks, but just briefly, this is, you have your reported income statement, and then you have your income statement that you're providing a buyer that includes additional income or lower expenses because you want to get credit for everything. So let's talk about what it's like. Let's say you have a company that's trading for $12.5 million. Between their cost of goods and the SG&A of just under $12 million in expenses, so their operating income is $550,000. We add back the depreciation and interest, so now we're at $600,000 of EBITDA. For the sake of argument, let's say that it's trading at 6 times. This company then is worth $3.6 million. Pretty straightforward. Scenario 2, same revenue and expenses, same depreciation and interest, but now we have Addbacks. Let's say the owner of the company was paying herself $300,000 more than market. Let's say the owner of the company had season tickets to the Brooklyn Nets, which definitely should be accounted for as discretionary. Then you add that back to your income. So your EBITDA isn't 600,000, it's now 900,000. And at that same 6 times, the company is now worth 5.4 million, substantially more. Scenario 3, similar, but in this case, the buyer took a look at things and says, well, of that 12.5 million, $1 million of it was from a company that you control, and frankly, we can't depend on that million. So really, it's only $11.5 million of revenue. Well, we're going to come in and say, well, we can shave that $1 million to the extent that their argument is correct. We'll shave that $1 million, but we also have to shave some of the costs because it cost us something to provide that $1 million. So we'll shave some of that cost of goods. So now our operating income is 506,000. Same in Addbacks. Now we're at 856,000 of EBITDA. 6 times is worth 5.1. Here's the moral. The moral of the story is every dollar you find in Addbacks, in this case, in a market that's trading at 4 to 7 times EBITDA, that's $4 to $7 in your pocket. Now, with that said, you have to know them, but you also will have to defend them. So it is not uncommon to require credit card statements. I've had potential buyers ask for proof that gas was being put into the owner's boat was coming out of company funds. And so you'd oftentimes have to prove it to the extent that they make an impact on your consideration. Some of the Addbacks, the most common one is compensation, but there are others as well. Legal disputes are usually one time, hopefully one time, so they're not recurring and they're usually taken out. One-time accounting fees, such as changing your accounting status, the type of corporation. If you've been moving to a new facility, if you own the real estate in which your company operates and you're not charging yourself fair market rates, maybe you're charging yourself higher or lower. Those can be either add-backs or takeaways. Repairs and maintenance that should have been capitalized, that is usually a net, pretty close to net zero difference, but we would typically take out those expenses, then capitalize them. Management fees is a big one. If you have another company or companies to whom you pay management fees, if you are doing this for tax planning, it becomes an add back or takeaway. If you're paying those management fees to a company that you own, and those fees are actually at fair market value, then absolutely they can remain. But to the extent that they are either higher or lower than fair market, you could have an add back or takeaway. Personal perks, let's just say perks. Those are very commonly added back. Here we're talking about season tickets, airplane, company vehicles, healthcare that is for a non-working person, family that's in the business but not actually in the business, things of that nature. Charitable donations are considered discretionary. I don't particularly love this one, but it also makes sense. To the extent that your company is making charitable donations, if I were to come in and buy the company, I might donate more or less. So we, rather than make that part of the value of the company, we add it back. Takeaways, your primary takeaways, again, compensation. So maybe you've been underpaying yourself for tax reasons or other purposes, and I now need to go out and hire somebody and pay him or her more than you're paying yourself. Non-recurring revenue, like I showed you on the previous page, the 12.5 down to 11.5. Did you have a windfall contract that's never going to come back? In the traveling nurse space, or frankly in any space, if there is a once in a blue moon 4-month strike and your company benefited from providing staffing in the face of that strike, that may not be a recurring event and you may lose credit for some of that. And then unrelated business activities, if you have a company that is a business line that is technically not part of your primary business line, let's say you provide dealers for blackjack, but you also take a cut of the winnings. That probably isn't happening for anybody in the audience, but in all likelihood, you'd lose credit for the cut of the winnings. Now let's talk about another add back, payment protection plan. We see a lot of this right now. Towards the end of 2020, there was a lot of questions in the air. This is pretty much settled down. I'm going to tell you right from the get-go, any potential buyer is going to tell you to remove this income. It is par for the course that any buyer tells you. If you got $1 million of tax-free income because your loan was forgiven, they shave that $1 million off from the beginning and they won't even consider it. And then it becomes your sell-side advisor's responsibility to actually analyze what happened. And the real question here is, if you hadn't received the PPP, what would your expenses have been? In other words, would you have had to lay off workers? And if that's true, then your expenses should be reduced as well. So for instance, using this prior example, got 6.6 million in value that's derived from the PPP income, partially, the $500,000 of PPP income in line 4. So buyer's going to say, nope, you don't have any PPP income, so we're going to take that out. And what we might say is, okay, we'll take out the PPP income, but we're going to take out, in this case, nearly the same amount from operating expenses. And maybe it's not the same amount. Maybe it's only 50%. Maybe it is the full amount. But we'll arrive back at the same margins we were at, because if we hadn't received this income, our expenses would have been reduced. This is one of those things that sign of a good deal is when neither side is particularly happy. So most of the time, this ends up being somewhere in the middle. So then briefly, comparison of the two, succession planning versus selling. Why? Well, you do succession planning because you're maintaining direction, whereas on selling, you're exiting. The purpose is you're trying to get it into the next generation of leaders in your family or otherwise, whereas when you're selling, you're looking to maximize the business. Standard of value is fair market value versus investment value. And investment value is determining what the value of the company is to the specific buyer. So real quickly, just a quick summary of some of the differences. If you're gifting to a family, you want to try to maintain no control, so you get those discounts. You want to at least consider A and B shares. And you want to probably minimize your add-backs. Whereas if you're selling to an employee, the employee, he or she is going to want control. So that's not going to be there. You want to take a look at the add-backs and make them appropriate. And if need be, you want to at least consider an ESOP. When you're selling to a third party, almost always you're going to be selling control. You should maximize your add-backs because they are going to try to minimize them. And you want to structure it quickly. You want to structure the payment appropriately. So let's talk about structuring. We're not going to spend a lot of time on this because we are going longer than even I anticipated, but here's the quick story. Any offer you receive when you're selling your company, there's an inverse relationship between the amount of cash you get and the amount of time it takes to get it. So if you're getting cash on the barrel, you can expect a lower payment or lower consideration. If you're willing to finance it or accept it over a longer period of time, you might get more in the long term. You need to make a risk assessment based upon the quality of your purchaser. And that is part of your sell-side advisory team should do. These future payments can take the form of seller notes, earnouts, and holdbacks. I can tell you that nearly 100% of transactions that are occurring in the last 18 months are going to have some level of holdback, and we expect that to continue pretty much indefinitely. Earnouts depend on the industry. In the staffing industry, we do see a number of earnouts to make sure that the transition is effective. So you get paid more if the company earns a certain amount. And then seller notes are very dependent upon the size of the company being sold and the financing that's being brought to bear. So, in summary, what to do? Prepare your finances. Think about what your goals are. Determine the value of your company, even if it's a broad value. Review your management team, who's going to take this over if you leave or if you sell, and engage your advisors. What not to do. Don't talk only about EBITDA. And I know that's kind of ironic because I just talked about EBITDA nonstop. But the truth is that one company's EBITDA can be completely different than another's. So at some point, you need to take EBITDA down to cash flow. And that's what happens when you engage your advisors. Cash flow being your EBITDA minus what it takes in capital expenditures, minus changes in net working capital, and minus other expenses that may be needed in order to keep the company in business. Make sure your attorney reviews your LOI. Don't sign it without him or her looking at it. Don't expect smooth sailing. Every transaction I've ever done, from tiny $200,000 transactions to very large transactions, there comes a point where we assume that this is not going to occur. And that is par for the course. There's a point where the seller thinks that the deal is dead, and then it comes back. Don't assume good faith. I wish we could, but it's like the old saying, check, trust, but verify. And then finally, whether you're selling or whether you're looking at succession planning, the one thing I don't think you can afford to do is wait. There's a lot of money out there right now chasing fewer and fewer companies. And to the extent that you are on this webinar, other than just being interested to see what I look like, it means that you are considering at least some of these things. And this particular market, from a tax standpoint and from a market standpoint, is very frothy and is unlikely to be this way indefinitely. And with that said, I am done a lot longer than I expected, so I missed my 45-minute estimate. With that said, I will be on here for another couple minutes if anybody does have any more questions. And then my contact information is also included, which I will go back to the original screen. So if you want to email me with any additional questions or any thoughts, please feel free to do so. I can also hand out this presentation. It is relatively large, so I did not want to attach it to this webinar. But with that said, if there aren't any other questions, and I don't see any, I think we are done. So thank you again, everybody, for attending, and I wish you the best of luck, whatever direction you're going. Keep up the good work.